Hi, this is Professor Rujo with some information on Chapter 1, Learning Objective 2. So, Learning Objective 2 goes over basically three different types of business activities. Okay. They're classified as either financing activities, investing activities, or operating activities. And we're going to take a look at each one in more detail. So, the first type of activity that's described is something called a financing activity. Now, the word financing should be relatively familiar to you because oftentimes when you purchase something large, whether it's a car or even your college education, one of the questions they'll have for you is how you plan to finance this. That's a financing question. So, financing activities are where we get the money to buy things. Okay. So, for a corporation, financing comes in two forms. They can either borrow the money or the owners can put the money in the company and thus the owners can purchase assets for the company. So finance activities really comes down to what we call liabilities, which is the amount of money that's owed to others for debt. Not all debt comes from bank loans. There's actually lots of ways businesses can get money, including banks, but not specifically exclusively for banks. Um, so liabilities are what we consider borrowing money or debt activities. They're part of financing because they use that money to buy things. The other way is the owners can put money into the company in exchange for equity. So the word equity is an interesting term because equity simply means ownership. Okay. The amount of equity you have is the amount of ownership you have in something. Ownership of a corporation is specific to what we call common stock. Corporations, as we learn in Learning Objective 1, are broken into shares of ownership. And so if you own a share of ownership in a business, you are a stockholder. Those shares of ownership are called common stock. Okay. So common stock is a form of equity, and it simply means it's the owner's claims on the business. Liabilities are considered basically claims of the creditors. A creditor is anyone who will lend you money, is a creditor or a lender. So liabilities and equity are financing activities that businesses will go and use in order to get money. Again, either borrow money or they have the owners put the money in the business so they can use it to to buy various things. What did they buy? Well, that's what the investing activities are really about. So, if you're a business, what would you want to buy? Well, you'd want to buy things that help you sell your goods or services because the whole purpose of being in business is to sell whatever product or service you're selling. Okay, that's how you make money by selling your products, by selling your services. So, the type of investing activities that we really look for in business are what would the company buy to help them sell more of its product or services? So, for the most part, we consider most of those assets. Okay, so a company might purchase various resources, which we call assets, like computers, like for example, delivery trucks, like furniture, buildings, and other types of equipment. Those are used to help the company produce and sell its products and services. Those resources are specifically known as assets. Okay. It is possible for companies to actually own investments. In other words, purchase stock in another company or things like this. But if you are a business that sells goods, and you're not an investment company, then having those investments are relatively useless because they're not providing you with ways to sell your product or service. Remember, you have to have a focus, and that's selling what you're meant to sell. Right. So investments are definitely part of these activities, but they're not what we would consider the most common. The most common is to purchase more resources, which we call assets. Operating activities are anything in which the business is doing while it's operating. So the word operating is when a business is open. So when a business is operating, it's open. So what happens when a business is open versus businesses that are closed? Well, when a business is open, it can sell goods and services. So when you sell goods and services, what you get is revenue. So revenue basically is the amount that you earn by selling goods and services. So, for a quick example, you walk into an ice cream store and you get an ice cream cone. Well, that ice cream cone might cost, let's say it's a specialty ice cream place, say $5. So that $5 that you pay to the store for that ice cream cone is the revenue to the store. Okay. Now, the purpose of the store is to sell its ice cream and various products, cones, shakes, etc. And so, however they sell the product isn't as important as the fact that whatever they collect is its revenue. Um, Depending on what type of store it is, if it's selling a physical product, that's a sale. If it's selling services, that's service revenue. So the difference between a sale and a service, a good and a service, is a good is a physical product. You walk into Walmart, you're buying physical products. They don't give any services there. It's all products. But however, you walk into your local hairstylist, you go to a hair salon, they are going to mostly be providing services, and that's cutting your hair, coloring, styling, whatever they do. But they might also be selling products as well as you're on your way out. Here, we use this shampoo and conditioner. We have these combs and other types of equipment that you can use at home. So there's some businesses that will sell both products and services. Okay. And then, of course, there are businesses that are in the business of making money through lending, and the interest they earn on what they loan is literally their revenue. So banks have a revenue stream that's basically interest revenue. They also have fee revenue as well because they charge you many different fees, right? Fee for this, fee for that, fee for breathing. They have lots of different fees. So those are all revenue streams. Again, if the company has earned it from selling a product or a service, it's revenue. Another type of operating activity is businesses that actually do sell products are always in the business of managing their inventory. So inventory is all the products that are on the shelf that are for sale to the customer. Okay. And so that's a very, very important type of account in accounting because for companies like retail, that's the sole existence for the whole company is to sell its inventory. So before they sell their inventory, of course, they have to buy it. They usually buy it from a manufacturer. They have it delivered to their store. Then they have to stock the shelves and then they sell it to the customers. And then once that's sold to the customers, guess what? They got to restock all the shelves. So inventory is a consistent and prominent and very important type of activity and a very important account in accounting, specifically for retailers. Accounts receivable is a type of an account where you have already sold a service or a product to a customer, usually to business customer, and you're going to wait to receive payment. Okay. So this doesn't happen. You and I can't go into a store, buy, say I'm going to take all this stuff, I'll pay you later. I mean, that's a one-way ticket to a shoplifting charge. But businesses that do business with other businesses often have those types of relationships where a business might sell to another business what they call on account, which means, look, I know you, we've been doing business for a while. You come on in, you buy what you need, I'll give you an invoice and you pay me later. Well, for the business that sold it to that customer, that's an accounts receivable. They're waiting to receive money on that account because they just sold a whole bunch of things, but they haven't received payment for it yet. So that's the receivable part. So that is, again, that's usually strictly for business to business. Many, many years ago, you could have done that in certain stores as an individual, but today, no. Businesses, yes. Another thing that happens while the business is operating, again, that's when it's open and open for business, is it's paying all different types of expenses. So an expense is basically the costs of doing businesses. Oftentimes that comes down to using up some of your assets and thus needing to expense them, or needing to pay for various services, like businesses have labor they have to pay, and so those types of things would be considered expenses. These are just simply different types of expense accounts. Cost of goods sold is the cost of the inventory that the retailer has sold. There are selling expenses, marketing expenses, administrative expenses, like lots of different expenses you're going to be learning very soon. Matter of fact, in the very next objective. Um, Liabilities that might come up from the various expenses pop up during the day while the business is operating, including they collect a whole bunch of sales tax. If their products are taxable products, they will collect not only the revenue from selling the product, but they'll collect extra money for sales tax. Now, that sales tax is not theirs, it has to be passed on to the state. And so that becomes a liability called a sales tax payable. And that's very, very common. They also take a lot of taxes out of employees' paychecks before payday. And all of those, of course, that's not their money. That has to be sent to the appropriate government collection agency to help that employee pay their tax obligation. And so income taxes payable can not just be on the company's profits, but also on all the employee taxes that are withheld from their checks that have to be remitted. There's also lots of other types of liabilities that come up, such as the business itself might have done business with another business. That's a lot of business right there. By buying things and wanting to pay them later. Well, if you buy something and you owe money to that other business because you promised to pay them later, that's what an accounts payable is in accounting. So there's lots of those, and those only happen when the business is operating. Okay. Of course, at the end of the period, usually these are measured monthly. We look at how much revenue and how much expenses that the businesses had in a particular month. If the revenue is higher than the expenses, the business has a profit for that particular period. A profit is called net income. Net income and profit they mean the same thing. However, there are periods of time when a company has more expenses than it has revenue. And that means for that particular period, usually again, monthly is the typical measurement, that would result in something called a net loss. Okay, a net loss is when, again, the revenues that are monies collected from selling stuff just aren't enough to cover all the expenses you have in that particular monthly period. This is sadly what's happening to lots of businesses during the COVID crisis and the limitations that have been placed on the number of customers that can go in to buy stuff. Thankfully, we live in a period where the online environment has helped a lot of businesses stay afloat. That has brought in a particularly good amount of revenue for some businesses to survive. But net losses are a fact of life. And unfortunately, when there's a net loss, the owners have to cover the loss to keep the business going. Okay, and the last thing, the activities for Do It exercise number 2 at the end of this is very important to understand how we classify various things. And so when we actually rent property, rent is a type of expense. Okay. When we actually buy a truck is considered an asset to the company because we're going to be using it for hopefully a number of years. A note payable, the word note in accounting, you'll come to know as a loan. Anything with the word note means loan. Okay. Payable means that we have to pay it. So if you have to pay it, it's a liability. Ownership shares, this is when they say an issuance of shares, that means that they've sold shares of ownership in exchange for cash. So when you sell ownership, you're getting owners. and owners are buying common stock. So those shares of ownership is common stock. So the word stock and shares mean the same. They're the same thing. Stockholder, shareholder, synonymous words. They mean exactly the same thing. If you earned any amount because you sold a service, that's revenue. That's revenue. Okay. And if you owe anything to anybody, it's a liability. And that is learning objective 2 in a nutshell.